It's Eddie Ruettiger from the Ruettiger Group at Baird and Warner, and I wanted to give you guys some data and information on what's going on in the marketplace. As we know, you're seeing multiple offers, highest and best, and some people are going 20 or 30,000 over list and still not winning the bid. And starting with this from the census track, this is what we built in housing over the last several decades when it came to units on single family. And, you know, in the 70s, we had 11 million, 9.8, 80s, 10 million, going into the 90s, almost 11. 20, the early 2000s, we were at 12.6. And then 2010 to 2019, we only built 6.5 million houses. This is one of the components that we're seeing coming into play here because we've had a housing shortage actually for a couple of years now. As population grew, and you've got the two biggest demographics looking at what's going on in the market of baby boomers and millennials trying to consume properties. And now you got Gen Z stepping up into that also. I actually have a couple consumers that are, one's 18, one's 20. The 18-year-old's going to close in about a week and a half. They're in the market too. And that is not the millennial generation. That is the next generation, just to keep that in mind. So that doesn't mean it is a listing problem. Yes, overall, you can see from move.com, we are down 53% overall in listings, but a lot of that had to do with the drop last year in April and March. If you go back from April of this year, we're almost up 40% in new listings. We are generating. The total amount of listings are down, but we are down in listings. Closings are still moving, and we're still up in closings because a lot of those ugly houses are getting bought up in the market. I mean, that's really the big issue here. And you can see with inventory levels between 2020 to 2021 of how they've been shifting. We did have some inventory. We're about 3 months going into 4 months, depending on where you're at. Some areas were already down to 2 months. You see how the shift now, most areas are 30 days, a couple are at 60 days levels of inventory. So when they're looking at what the economists are predicting, we do see inventory starting to come back in the second half. And I think right now, being done with the holiday, being out of the normal school aspect, and with COVID schooling and how that was affecting everybody, I'm starting to see houses starting to come on the market. And I think we're going to see an increase going into this in the second half of this year. The fall or winter market could outpace enclosed units, the spring market, because of inventory. But again, it's not an inventory problem. We have these buyers, and we'll talk about that in a bit. Just the number of buyers in the market are, it's amazing how many people are out there looking to buy a house. 16% of American adults are considering a purchase of a home in the next 12 months. I mean, these are the numbers. That's 6 points higher than the trend that was 10% just a year ago. So you see where everybody is at. And then the average profit for selling a home has increased by 26%. Most people were walking away with around 55,000. You're just over 70 right now. I mean, so the point is, and Lawrence Yun has talked about this. I've talked about this on the radio show, and if you're not listening to us weekly, WJLL.com, or you can tune in at 1340 a.m. if you're near the Joliet area. Lawrence Yun, this is not a bubble market. It's a simple lack of supply. I don't think it's really a lack of supply. We have supply coming. It's a overabundance of buyers. So I know people are always worried about that bubble market. Like he said, it's not a bubble market, and I wanted to give some updates on forbearance. Forbearance numbers look outstanding, realistically. When we go back a year ago, we started at 1.76 million units that went into forbearance. Okay. We are down to 2.3 within a year. So a better than 2 million units came out of forbearance. Okay. 400,000 mortgages left just in like the last 2 months, looking at April and March. We're still compounding May's numbers, obviously, and getting all that in. But when you look at how they left, that's the big aspect. 25% made their payments during the forbearance period. They never fell behind. They just went into this protection to, be safe. 7.5% paid off the loan. 14.4% brought the payments back current after they fell behind. 26.9% deferred the loans, or the 9.6 that did a loan modification. So maybe they deferred the payments, put it at the back end. If you are still having struggles with your situation because of COVID, forbearance options are still out there. Take advantage of them. They're there. And then this is another part of that story is the interest rates. I mean, we're looking at a 2.98 coming into April. We did spike a little bit up to 3.5. We're back around 3 as I'm recording this and getting all set. Just the interest rates is basically they're giving you free money. I did an analysis a long time ago that if I had a $300,000 mortgage at a 4% rate, I'm paying basically $150,000 back in interest. So that a house would cost me $150,000 at 4%. All right, so it's costing me $450,000. At a 6% rate, I'm paying back $300,000. So now that $300,000 house actually cost $600,000. I've never done it at a 3% rate. I mean, so the interest rate and the interest that their banks are collecting is so low that it really is giving money away. Now, keep in mind, that's all based on a 30-year payment. And you guys all know when you talk to me, make one extra house payment a year, not the whole payment, but that principal and interest. You can get one house payment a year, and most people can do that by paying an extra $75 to $150 a month for most. You're going to knock 7 years off your mortgage. Now, that's if you started from day one. If you start now, hey, that's fine. Start it today. But make one extra house payment a year, if not 2, and watch the power of compounding interest. These are some of the predictions of going forward from Freddie, Fannie, MBA, which is the Mortgage Bankers Association, and of course the National Association of Realtors, of where interest rates are going to be. So we do see a tick up, but we don't see, unless something major happens, we're not seeing anything jumping up above 4 really fast. Mortgage Bankers Association thinks by second quarter of 2022 we'll be at 4.1, and that could be possible. There's a lot of things that are going to have to come into play. I think the inflationary numbers are going to have a big impact. We'll have to see and watch what happens. Home pricing forecasts, everybody's putting it around a 6%. I think locally we're going to be around 8 to 9, looking at the demand structure and looking everything that's going on. CoreLogic is being the most conservative at 3.5. I think that number is going to be blown out of the water for 2021. I think overall the country itself will be around 7% growth, and locally will be 8 to 9% on your home going up in value. Total sales, we did 6.5 million roughly in 2020. I think we're going to be pushing 7. Lawrence Yun, again, the chief economist for the National Association of Realtors, did say we could sell 8 million units if we had the inventory. The demand is that high. Our buyer's guide is out. If you haven't had a chance, please jump on that and download that. Just go to eddieruettiger.com and you can get right to that guide and check that all out. Housing supply year over year, as you can see, the supply year over year is just keeps getting dwindled. This is not new listings. This is just the supply of inventory versus the demand, and our supply keeps going down. Our new inventory we're seeing, and this is kind of what we're going into, we did not see a lot of homes jump into the market in March. And that really did put a this hyper over offers and everything into the market. And builders aren't really in the market either. They can't keep up with their demand, as you can see. They're struggling on month supply for new inventory. They're at 3.2. A lot of their supply chain issues. I saw a great stat in 2019, $50,000 of lumber would build you 10 and a half houses. Today, that same amount of lumber is going to build you 2.5 houses. So that they're running into a lot of costs when it comes to their supply and things along those lines. And here's that buyer demand story that I wanted to really talk about. And this is what's going part of another thing that's going on. So year over year increase in showing activity. All right. So in the Midwest, we are up 124.1%. All right, in showing activity. So that gives you an idea of the amount of demand that's going on in the marketplace right now. Buyer traffic is strong for Illinois. It's strong throughout the entire country. You really are not seeing any weak buyer traffic anywhere. And then the mortgage of the credit availability gives a whoops, jumped it there. You can see that there is a credit available out there, but it is getting a little bit pulled back and it is a little bit tighter. A lot of that I think has to do with a lot of your buyers are coming in with cash down, and those are the ones winning the bids right now. So that is a big aspect in that market. Most loans are closing as of March, and this is per Ellie Mae, within 52 days. A lot of this is now getting into, I'm seeing a lot of people asking for what's known as a reverse contingency. So you're buying, but you have to sell. All right, let me we'll accept your offer, but let us go buy a house basically now. And then for those that are always worried about the bubble market, that FICO score, the average FICO score from Ellie Mae was for credit score was 751. I mean, so we've got strong buyers in the market. When you look at overall, credit score distribution, you're seeing 44% of them between 749 and under, which means 50% of your buyers in the market have a 750 score or higher. That is some great data to be looking at. And then I like this. I think this is the best aspect. When you're looking at all loans overall, 751 is the average credit score. Conventional is 759, and FHA is 681, and a VA is 723. So, that is some pretty amazing stuff. The average debt to income on the back end is, a 35, 43 for FHA and a 41 on VA. So that's very low debt to income ratios when you're getting into almost, those a lot of those would still meet a conventional requirement where a lot of conventional loan products can go up to 44, some can go up to 46. It just depends on what it is. So there's not a huge amount of debt. I mean, keep in mind, these debt percentages are including the house payment of the new property itself. So that's pretty much everything we've got going on right now. If you got specific questions of what's going on in your area, your neighborhood, or just want to know something specific about your home, give me a call, 815-823-5478 at Baird Warner. Again, 815-823-5478.